Live News continues.
Welcome back to Solutions for Financial Independence. Joining me now, John Halterman with Beacon Wealth Management. How are you doing, John?
I'm doing great. How are you?
Doing really well, thank you. This week we have a question from Ben in Farmington. He says, could you please explain the new tax rule on the once-a-year IRA rollover?
Ben, that is one of the most confusing rules that's been around in a long time because, you know, people always get confused on what's the difference between a rollover versus a transfer versus a contribution. So let me clarify one thing. You know, an IRA rollover is where you take money out of a retirement plan, such as a 401k, 403b, and you roll it over into an IRA. So that's what they're talking about when they say IRA rollover. An IRA transfer is when you take an IRA and you transfer it directly from one trustee to another trustee, meaning you actually don't touch the money. So when the IRS came out with this new rule, what they're basically saying is if you're rolling over money from your retirement plan, you can't roll over multiples in 1 year. You can only do that one time. But once the money gets over to that IRA, if later you're not happy, you don't have to stay there. What you can actually do is you can request a transfer. So just remember the key words is rollover versus transfer. And as far as contribution, that's a totally different thing. The contribution is what you put in for that particular year and not necessarily the money that you had in prior years.
So just pay attention to specific words.
Absolutely. Pay attention to just those couple words, rollover versus transfer versus contribution.
All right. Thank you so much, John.
You're
Folks,
welcome.
if you miss anything, you can always find it online. Don't go anywhere. Much more for you after the break.